Welcome back to my YouTube channel. My name is MTrades. You can also call me Dimeji. This is the last part of our 3 series video, the finale. So the first part we talked about the US dollar. We talked about the market participants, the Forex market itself, the types of markets we trade, the crypto market, futures, and all of those things you can pick out from that particular video. Quite an informative video as well. If you haven't seen it, I think you should go back to that particular one, then watch the second part where we talked about margin, leverage, spread, lot size, bid and ask, and every other thing you can remember from that one as well. So this last part will be deep diving and progressing, going deeper into this particular journey we are currently on. So yeah, get your pen, get your journal, and let's go on a little journey together. All right, so yeah, so okay. So key concepts to trade with confidence. How do you trade with confidence? How do you develop confidence in trading? You develop confidence by understanding and knowing what to do, understanding technical analysis, and having the right knowledge. That is how you build confidence in trading. It's not guesswork, it's not gambling, right? You have to have the right knowledge to be able to approach the financial markets if you want to make consistent money from it, and if you want to become consistently profitable. So remember, the goal is not to be right all the time. The goal is to make better decisions with good risk management. So there are three things you need to have as a trader, right? As a professional trader, you're trying to be. Number one, you have to have a very good psychology. Very good psychology. It's very important. Number two, you have to have good risk management. And the third one, you have to have good structural knowledge on technical analysis. With those three things, you can hold your own in the financial market as a whole, right? Okay, so let's get started. So so the financial market has been in existence since the 1600s, the 1700s, 1800s, and like that. Back then, traders tried to use different methods, different ways to understand price movements, to read price movements, and all of that. So now we are in a digital age. Excuse me. We're in a digital age now, so it's much easier to read prices now compared to then, right? So the popular way traders tend to understand price movements and read the market is through Japanese candlestick. It's a very, very crucial and important topic. So you have to understand this particular one and pay close attention. So Japanese candlestick. So before we move a little bit deeper, let me show you my trading view. Yeah, so okay. So this is currently the charts of Euro USD on FXCM. This is the 4 hours time frame. All of these things you're seeing here, they are time frames. This is 1 minute, 3 minutes, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours, daily, weekly, and monthly, right? So what it means, it simply means that each candle you're seeing here, these particular things are called candlestick. Black, 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 green, green, black, black. They are all candlestick. So if you open your own trading view, by default, you would see green and red. Me, I changed my own chart color. I don't know, for some reason, I just fancy it this way. So I changed my own to green and black. So this black denotes as red on your own. Green shows you buyers. Black shows me sellers. Red shows you sellers on your own chart as well. So this is the 4 hours time frame of Euro USD. This is the chart. This is how it looks like currently. So this is where the current price is. This is the current price of Euro USD. Remember, in trading, we pit two currencies together. We trade the base currency and the quote currency. This is the base, this is the quote. Euro USD, like we pit two currencies together. In this case here, you can see them here. USD JPY, USD CAD, USD CHF. So me, I just put a fizzy in my own hand. Dollar boys, I just named them. I just messing around with them. Second 11, commodity, JPY niggers, and all of those things. So I'm just messing around with my own chart. Yeah. So by default, this is how it looks like. So the currency market is usually closed, like we talked about in the first video. Monday to Friday is always open. Saturday, Sunday is closed. Crypto is always open Monday to Sunday. Crypto doesn't close. The crypto chart doesn't. The crypto market doesn't close. It's always open 247. So this is the current chart of Bitcoin, BTC. You can see the price. This thing is moving here. You can see it's reading. This is the countdown. It's reading here. Current price is 63,200. You can see. So it moves on weekends as well. I'm shooting this video on a weekend, right? So yeah. So as we were saying, I was talking about the current chart of Euro USD on the 4 hours time frame. So all of these things you're seeing here, they are time frames, right? So it means for each candle you're seeing here, these are Japanese candlestick. For each candle you're seeing here, it takes them 4 hours for it to form. 4 hours for this guy to form. 4 hours, 4 hours, 4 hours, 4 hours, 4 hours. If I scale down a little bit below and I go to 1 hour time frame, it means it takes each candle 60 minutes, 1 hour for it to form. 1 hour, 1 hour, 1 hour, 1 hour, 1 hour. If I go to daily time frame, it means it takes each candle daily an entire 24 hours. 24 hours, 24 hours, 24 hours, 24 hours, 24 hours. If I'm on the monthly time frame, it takes each candle 4 weeks approximately, an entire month for this red candle to black candle to form, for this green candle to form an entire month. You can see, look at the amount of days remaining. You know, we just started July now. Look at the amount of days remaining, 26 days, 22 hours for this particular candle for Euro USD to close. Sure, you understand? So if I go to the 1 minute time frame, each candle you're seeing here, 1 minute, takes them 1 minute to form. So that is what it means. So now, in the olden, there are some traders that actually prefer to put their stuff on line charts. Not everybody uses Japanese candlestick, but it's generally accepted. Like 95% of traders use Japanese candlestick. Some other traders prefer to put their stuff in line, like put it on line charts. So this is, you can come here on this tab section. If you click here, you see it. Bars, these are different ways we identify price on the market. We can use to read price. Bars, if you change it to bars, you can see this. You can see it's a little bit different. If you change these bars to candles, you can see this is the normal candle, Japanese candlestick, how we read by default. If you change it to Olo candles, you can see it. If we change this guy, so we change it to yes, line with marker, step line, all of these things. Sure, you understand? So, but what you just need to know is you can use area as well. You can see, so different ways people try to read price on the market, but by default, people traders mostly use Japanese candlestick, because this one you are able to understand each candlestick as it forms. Like you can look at this, you can see this particular big candle, this big body candle here, that, oh, look at the strength of this particular candle, and you should you understand. Unlike when I'm just using line, you see I can't really tell what really happened here and stuff like that. So yeah, just thought I should share that particular thing. All right, so before we deep dive more into Japanese candlestick, let's talk a little bit about Japanese the candlestick itself. Let's talk a little bit about it. Where can I find that now? Let me see. Okay, all right, so stay with me. So what are Japanese candlestick? It was developed by Japanese rice trader Monhisa Oma in the 1700s. It is used to show price movements over a specific period. Every candle tells the battle between buyers and sellers. Remember, price tells a story. Candlestick help us read that particular story. It's very important. Every price you're seeing on the chart tells a story. Candlesticks, that particular thing I just showed you now, helps us to read that particular story. Now, what you should understand is the market, the financial market, trading as a whole is a constant battle between buyers and sellers. It's a war zone, a crazy place actually to try and make money from. It's a war zone. There's constant battle between buyers and sellers, constant battle between demand and supply. One is trying to take charge. Sure, you understand? Like, one is trying to dictate price, the other one is trying to, no, we don't like this price at this particular level. So that is how it is. So in trading, one key concept, one key thing you should know is the trend is your friend. You always have to try and trade in alongside the trend. Don't fight the trend. When you see that the market is dropping real hard, when it is selling real hard, you try to trade alongside that particular trend. When you see it buying, you try to buy with the major direction, the major order flow of the market. Don't try and fight it. Trade alongside with the trend. That way you are able to make good money on the market. Right? So yeah, so moving on. So why candlesticks line chart shows only closing price, is less information, harder to read momentum, and is not ideal for traders. The line chart I just showed you now. So these are the disadvantages. Candlestick chart shows you full price action. It has more information. It is easy to read, and it's preferred by most traders. So professional traders use candlestick because they review market psychology. So this is why most people leave their chart on candlestick chart. It's much better. You're able to read price. You're able to tell, okay, this is who is actually in control based on the candlestick strength and weakness. All right. So moving on. How is a candle formed? Every candle has 4 prices: open, high, close, and low. Open is the first traded price. This is the open. High is the highest price reached. Low is the lowest price reached, and close is the final traded price. So let's delve into that particular thing a little bit so you can understand. So we have two types of bullish candles, 2 types of candlesticks: bullish candle and bearish candles. So you should note this. So let me just put a little bit small diagram here. Okay, so what we are trying to discover, what we are doing now, is called candlestick anatomy. It's very, very important to know how those particular candlestick you're seeing on your chart, how they are formed, how they form is important for you to know them. All right, so just stay with me. Okay, so each time you see green candles on your charts, know that they are identifying buyers in the market. So they are also called bullish candles. When you see green candles, these are bullish candles. They identify buyers' strengths in the market, right? So when you see green candles, they are bullish candles. When you see red candles, they are bearish candles. These ones identify what? They identify bearish candles, identify sellers in the market. All right, so you're getting somewhere. Just hold on. Okay, all right. So an anatomy of a candlestick, how these particular candles are formed on the market. So now, bullish candles, what you should know as well, we just talked about 4 price level, how these particular candles are formed. They have 4 ways in which they form 4 price levels. So what you should know is bullish candles, they open from down and they close up. Bullish, when something is buying, like we say, identify buyers, right? When you want to buy something, like, it opens from down and it goes up. Selling opens from up and it comes down, basically. So bullish candles usually open from this price level. This is the open price for bullish candles. This area, this down here is the open price for bullish candles. So it means the candle starts from here, opens here, right? So, and it closes up here. Closing price. This is the closing price. This is the lowest point the market got to, the low, and this is the high. Just stay with me. This is the highest point the market got to. So these particular things you're seeing here, they are called tails or wicks or shadows. Some books will refer to them as wick, some will refer to them as shadow, some will refer to them as tail. Wicks or tails, so you can call them any of, you can call it any of this particular, you can see it here. So this is the anatomy of a bullish candle, right? So bullish candle opens from, this is the open price, like we said, it opens from here and it closes here. Now these wicks that you're seeing on the charts is telling you what wicks basically represent. They represent rejection, disagreement in price. You know, we said the market is a constant battle between buyers and sellers. So at sometimes they disagree on price. Both of them don't really agree that, no, we don't like this price at this particular level, we want to push it up. Or we don't like this price at this particular level, we want to push it down. That is what they do on the market, and it reflects on those candlesticks. Now this is the open price, like we said here, right? So it means at some point when this guy started from here, this particular buy candle, this green candle started from here, opened here, traded all the way to, it was selling at some point. It's why you are saying this week, it was, when it opened here, it was going down at some point, selling until the buyers around here started rejecting the price, pushing it back up, then they pushed it all the way to this high before sellers stepped in to push it back to close the price here. Like we said, those candlesticks, you're saying it's a constant battle between buyers and sellers. When you see wicks, just know that one of them rejected the price, one of them pushed it. So sometimes you see some small candles with very long wick. It means there was massive rejection inside a particular candle, massive disagreements inside a particular candle. So that is what it denotes. So you can see we opened here and we closed here. The important things you need to note in these candles are the open price and the closing price. Very, very important. In between here, this place is called the body of the candle. So this is the body of the candle, this particular place. So this is the body of the candle. This is the body of the candle. This is the wick, the wick. You understand? So when you see these wicks here, these tails or wicks, it signifies rejection. It means at some point this particular green candle you're seeing got to this high, got to all of this place. Like the body was so filled up, it got to all of this place before sellers rejected the price. They pushed it back down, but they were not able to push it down to the extreme levels. They just closed it. The market closed there. When you see wicks to the downside, it means at some point the market was actually selling. It's the same thing with this one, but the difference is, for bearish candles, we said it opens up open price. For bearish candles, up here, bearish candle opens up and it closes down. When something is selling, like dropping, it starts from up and it drops down. When it is buying, it starts from down and it goes up, right? It closes up. So that's the difference between the two candles. So this is the closing price for bearish candles. This is the body. And this is the lowest points the markets traded into. This was the highest points the market got to, and those places are also called wicks. So basically this thing is also a wick. So this is the anatomy of a candlestick. Once you can put this diagram down somewhere. Once you understand this, you are able to read price much better. So bullish candles opens down and closes up. Bearish candles opens up and closes down. So it means this particular candle, when it started from here, went all the way to this place, got some rejection, they pushed it down. When you see this long wick, it means there was disagreement in price. Is why you are seeing this wick. It was moving up at some point. It was all green and all of that at some point before they pushed it all the way down, creating a long wick like this. Pushed it all the way down to this place. The market got to this, the candle got to this place until buyer stepped in. Then the candle closed there. Now what we look at when we are talking about candlestick, we usually look at the body, how big or small it is. When you see big body candles like this, it simply means there's conviction, there is strong momentum in that particular candle. Like this one can easily tell you that, wow, there is buyer's momentum in this particular candle. Because there are some candles you would see, those candles forms in different shapes and sizes. You see some are very tiny like this on your chart. I'll show you examples on TradingView. There are some of your candles are like this. You see some don't even have wick at all. They don't even have wick at all. You see them like this. If you're comparing these two candles, these ones are stronger than these ones. This particular candle, you can see the body here. Look at the body. Look at the body of this. You can put like two of this inside this. Sure, you understand? The same thing with this and this, right? So there are also candles that forms like this with small body and long wicks. These particular candles are called hammer candles. So basically, let me just put this very well. So you see some candles are like this with very long wick. Some are like this. Some are like this, small body and long tails to the upside. So these are different shapes and forms the candlestick forms on the chart. Let me show you on TradingView what we mean by that. Let me change this guy back to candles. You can see them. Oh, okay. Should we go to BTC since the crypto market is currently open? So I don't want to delete my markup. BTC USDT. Let me see. Okay, all right. I don't want to delete my markup over there. All right. So look at this particular. You can see. Look at the different shapes and sizes of this particular candle. Look at this big body candle here. It means this guy opened here. This is a bullish candle. It opened here, went all the way down. Look at it. This wick you're seeing here means this at some point when this guy opened, traded all the way to this place, went all the way to this place, to this eye here, you see, and closed back down. This particular candle, you can see. So this is a bullish candle. Look at, can you compare this candle, the strength of this particular guy to this guy? You can see the contrasting difference. So this one is telling you there is more conviction in this particular candle. There is more buyer's momentum than this particular one. This one is also a buyer's candle, but this one is stronger. Look at this particular red candle here, this black candle. This one is also a very strong seller's candle. Compare this guy to all these small ones you're seeing. Right, so candles come in different shapes and so the candle tells us the story. So the wicks shows rejection and acceptance, right? So look at this strong rejection here. Strong. At the end of the day, the most important thing is, after the whole rejection and all of that, how did the candle close? Did it close very well? These are examples of candles that closed well. Look at the body, closed up here. Compare this to this particular one. Let me look for a candle with very strong rejection. Look at this particular let me see. Let me look for let me see. Okay, let's use this as an example. See this guy here. See this particular candle. See this one. Bullish candle opens from here, right? Went all the way to this place. So this particular candle went all the way to this place. Then sellers pushed the price back down and it closed here. You can see the contrasting difference between this, how this one closed and how this one closed. This one is times 20 stronger than this. So you understand? So that is how we identify strong and weak candles in the market. So this is an example of a weak candle, strong candle, weak candle, strong candle, strong candle, weak candle. So you just want to look at the body and the size. Strong bearish candle, weak bearish, weak bearish. So you understand? So you want to look at the body and the size. So there are like over 300, 350, 400 candle names. You don't need to know all of them. You just need to know the important ones. So I'll be giving you some of the important ones here that you need to know. So this particular candle, this one, you just need to be able to identify them because they tend to help you make better decisions at key levels. There are some candles that once you see them at a particular level, you know that it's like this market is about to reverse, right? So the name of this particular candle is an armor. This is called an armor. You know what an armor is now? Basically like an armor, it's very small body, like real life armor. Small body and a very long tail, right? So this is an example of a armor, right? So this armor are very strong candlestick, like very strong candlestick in terms of what they do when we get to key levels and all of that. So these guys, when you see candles like this, they tend to reverse the market to the opposite side, right? So this is an example of a armor. This is called a bullish engulfing candle. I'm going to put that down here as well. This one is called inverted armor. So like basically armor, inverted armor, like flip side. Just flip it. All these big body candles, these candles with very, very big bodies are called bullish engulfing candles. These big body candles are called bullish engulfing candles. These ones are called bearish engulfing candles. So very important candles to be able to identify, right? There's one other candle that's, it looks like this, looks like a cross sign. Another important candle for you to know, looks like a cross sign. So when you see it, you are able to just identify that, okay, this is the name of this candle. Look at it. This is how it looks like. So this candle is basically called a doji candle. Doji. So this candle is called doji. So it means that this candle shows indecision in the market, like there is no winner. You know, I told you those candlesticks shows you constant battle between buyers and sellers. It's why you are seeing all those rejection and all of that. So this doji candle shows that the market opened here, went all the way up, went all the way down, and closed as a plus. 50-50, no cheating, like straight draw. Do you understand? So that's what doji signifies as. You understand? So doji shows you it's an indecision candle. There's no winner. There are some doji candles that are also like this. You see them with small body like this. You see them something like this. They are also called, see them, it's just numerous names for all of these candles, but I'm just pointing out the important one. If you want to deep dive, if you want to know more about candlesticks, just go to Baby Peeps. I think I gave you the website in the last class. So there are some candles like this as well. These ones are called spinning top. See them like this, spinning top. This is doji, right? So yeah, so we needed to just talk about that particular stuff. So yeah, we've been able to talk about open, high, low, and close. OHLC, that's the short form. Open, high, low, close. You understand? So bullish candle opens here, closes here, high and low. Close is greater than open. It's very important to understand the closing price. How those candles closes tells you how strong or how weak it is. You understand? So it means buyers control the market is usually colored green. It opens at the bottom of the candle and it closes at the top. Bearish candles, open is greater than close. Sellers control the market is usually colored red. Open at the top of the body, like what we just explained, and closes at the bottom. Candlestick anatomy, this place is called the wick. We've talked about it. This place is called the real body. It shows the range between open and close. Then this place is called lower wick, which is the shadow. Body equals to strength. Long body equals to strong momentum. Small body equals to indecision. When you see long bodies in the market, it's telling you there's strong conviction, there's momentum, there's strength in the candle. When you see small bodies, it's showing you weakness or indecision. Wicks equal to rejection. Long wick equal to rejection of price, short body. So what does each candle represent? Each candle represents one period of time. So basically, whatever time frame you are on, like when we're talking about time frames here on this BTC, I'm currently on the 1 hour. Each candle takes 1 hour for it to 60 minutes. Look and see, this one just started now, right? Look at it. It's remaining 40 minutes. This is the current price. This is where it is at the moment. It's still forming. You can see it's remaining 40 minutes for this candle to close. If I drop down to 15 minutes charts, you see it's remaining just 10 minutes for this particular one to close. You understand? So it's depending on the time frame you are on. On the daily, the candle just started. It's remaining 23 hours 39 minutes. Sure, you understand? So aligning those time frames is very, very key. You don't need to trade all the time frames. The way I trade, I start from the daily. I use the daily to understand where the direction of the market is going. Then I drop down to 4 hours. I start looking for trends. I start looking for how to enter the market. Once I've been able to identify, remember, I trade with the trend. Once I've been able to identify the trend on the daily and mark my key levels and all of that, then I start using the 4 hours to know that, okay, should I buy from here? Should I not buy from here? Should I sell from here? Should I not sell from here? Then I use the 1 hour to time my entries, right? So that is how I run this thing. So key takeaways: candlestick show market psychology. Open, high, low, close forms on every candle. Body equals to strength. Weak equals to rejection. Bullish equals to buyers are winning. Bearish equals to sellers are winning. If you need more in-depth knowledge on Japanese candlestick, there is a big manual. It's called Candlestick Trading Bible or something like that. Just search for it on Google. You would see over 1 million candlestick names, but the important ones are the ones I've talked about here. And the more in subsequent videos, when I'm talking about more market analysis and all of that, you see me still mention some of these things, right? So, but it's a good start, good stuff to know, good nuggets. So moving on. Okay, yeah, let me show you some of those. I'll show you. All right, so look at the type of candle patterns: bearish, bullish. You can see some of the names here. Hanging man is a candlestick pattern with a long wick. Look at it. Shooting star, gravestone doji, bearish engulfing, dark cloud. So there are many of them: bearish arami, bullish arami, and all of the evening star morning. But these are very important candles to know. You can just know 5 or 6 that once you see them on the chart, you're able to identify, oh, this is a bullish engulfing, this is a shooting star, so these are type of candle patterns, you understand? So yeah, good stuff. All right, so moving on. All right, so we've talked about Japanese candlestick anatomy. We've discussed this. Candlestick patterns, we've discussed this. Market structure. Now we have 3 types of market structure. We have uptrend, downtrend, and consolidation range. When you open your laptop, when you open your phone, when you open TradingView, you want to analyze, you want to do anything, the first thing you have to do as a trader is you should be able to first identify the trend. Oh, is this thing buying? Is it pushing up? Is it pushing down? Is it just consolidating? Like, consolidating means it's not going anywhere. It's just in a tight corner. It's in a box. It's just ranging like up and down, up and down, up and down. It's not going anywhere. Right? If you cannot identify the structure cleanly, just leave the pair and go to another one. I'm going to show you examples. So uptrend shows you higher highs, higher lows, higher highs and higher lows and higher high. Downtrend shows you lower high, lower low, lower high and lower low. Consolidation range, price move sideways between key levels before the next move. So let's go back to TradingView. Let me show you what I mean by that. So let's stay on BTC still, but let me show you one particular thing. Let's come here. Now, this is how the market moves. Let me use this horizontal line, 1 and 2. This one is a black line, this one is a green line. So now, this is how the market moves. The market moves, this is the current price. This is BTC at 74,000. Let's just say 74,000 currently. Now, you've done your analysis. You know the market wants to move from 74,000 to 92,000 US dollar, right? the market will not just move, like it will not disappear from this level. It will not disappear from here and just go up like this. If it does this every time, all of us will be making money. I'll be a billionaire by now, in fact. But the market doesn't move this way. Yeah, this is how it moves. You can see clearly that this guy is going to buy. He's coming from this 74,000. He's heading straight to 92,000. But what it does is it doesn't just move in a straight line. It moves in a zigzag way, like ladder. It's climbing ladder, like it's going up. It pushes up again, comes back down. Pushes up again, comes back down. Then finally, it hits the targets. This is how the market moves. This is why it's a little bit difficult to make money consistently in the market because of all of this move. Because sometimes it's not even as clean as this, but you need to be able to identify the trend. So this is an example of a uptrend. You can see it's gradually pushing up. Now, why is it moving like this? It's moving like this because based on economics, when you want to buy, you understand, buy when the price is low, sell when the price is high, right? You can't go to the market now. You want to buy a phone, you want to buy a product, you want to buy a laptop, and all of those things. You can't go there and start buying it at a very expensive price. You want to buy it at a cheap price, right? So when the market started its algorithm, when the market started its run from here, right? When it pushed up, pushes back down, it's giving people opportunity to buy at this particular level. People that could not buy from here, that didn't get in from here. When the market got to this place, you don't pursue the market, you don't chase the market, you allow it to drop, let it come down so you can buy at a very good discount price. That is how it works. Buy low, sell high. Buy low, sell high. So when the market is already at a higher price like this, it will drop a little bit, allow new buyers to come in. You understand, like entertain new buyers. People will get in at a very good level. It will push up again. It will come back down again. For people that didn't catch it here, give you another opportunity to buy at this level. Pushes up again, comes back down, pushes up again. This is how the market delivers uptrends. Now, what is it doing? It's basically moving and breaking new highs and new lows. You can see here, this was the previous. Let me just put it here. So you can see this was a previous high. It came down, it broke it. Came down again, it has broken this particular place again. You can see it has broken it again. It has traded down again, it has broken this particular high. So these places that it is breaking is called, these are higher highs. Higher highs. You can see. So these are higher high. This is why we call it, this is why we say the market moves in higher highs and higher low. You understand? So this previous low is called higher low. You can see it here, right? So because this low is higher than this one, this low is higher than this one, this low is higher than this one. That is how it will continue climbing up till it smashes the target you are looking at. So market moves like this in an uptrend. Higher high, higher low, higher high, higher low, higher high, higher low, smashes target. So you always want to get in at those higher low. You want to buy when it drops to that higher low. You buy from there, pushes up, you make profit. It comes back down, you buy again, pushes up, you make profit. That is how it works. You don't buy when it is at the high. You buy it when it drops to the higher low. So this is an example of a clean uptrend. Right, so the same thing for a downtrend. When you see the market dropping hard, you see something like this. The market, if it's in a downtrend, it moves like this, moves in this manner. It will not just jump from that place to this place. No, to move the same way. Come up, come down, come up, come down, come up, come down, come up, and smashes targets. So for a downtrend, I'll show you examples. Just stay with me. For a downtrend, the market is moving in, is moving in lower lows. This is lower lows, and this is called lower highs. You can see. So when you are trying to sell, when you see the market dropping, You remember what I said, trade with the trend, don't fight it. So when you see the market dropping and you want to trade alongside the trend, always buy at lower highs. Look at it, lower lows, lower high, lower low, lower. Why is it coming back up? It's giving people opportunity to sell when the price is high. You can't have something you want to sell now. You go to the market, somebody will be offering to buy it from you at $100. This other person is offering to buy it from you at $125 or $130. Of course, you want to sell it to that person at $130 to make good profit, right? So that is how the market works, right? So you always want to sell when the price is high. You buy when the price is low. Basic economics. So look, this is how the downtrend works. So this one now is called bullish markets. Remember what bullish means? Bullish means there are more buyers in the market than sellers. So this is a bullish trend. So instead of saying that market is, you can call it different name. You can say it's in an uptrend. You can say it's a bullish market. It's denoting the same thing, telling you that there are more buyers in the market than sellers. This one, bearish trend, there are more sellers in the market than buyers. That is why it's creating lower highs and lower lows, lower highs and lower lows, lower highs and lower highs and lower lows. So these are the things you need to first identify when you open your trading device. You first need to identify how is it an uptrend or is it a downtrend. If you cannot cleanly identify it, just stay away from the chart. So the last one of the trends is a consolidating market. The consolidating market is when the market is not really doing much. It's just moving in between. It's not buying, it's not selling, it's just doing things like this. Hi, look at it. It's just like moving up, going down, doing it. So this one, there is no winner between the two of them. There is balanced price action here. Both buyers and sellers are struggling. So wherever this guy breaks out, if it breaks out to the downside here, then sellers have won. They'll continue selling. If it breaks up to the upside like this, it means buyers have won. They'll continue buying. So markets like this, you stay away from them until they break out. So this is a consolidating market. No clean direction. So let me show you example of these trends. Let's go to Euro GBP. No, I think the best example is oil, US oil. Yeah, so this is the current price of oil, $68 per barrel. So so this is the current price of oil. It has been dropping recently because US and Iran has finally had a peace agreement, so it has been dropping seriously. But that's a different topic for another day entirely, right? So that's the price of oil at the moment. So look at these. Look at how clean this particular down. You can see once you open your chart, always zoom out. This is the current price. This is where it is. You can see this is where the market is at the moment. It's closed till Monday. Sure, you understand? But look at how clean this downtrend. You can see how just if you zoom out, you can easily tell that this guy is falling now. So this is how you are able to identify a clean downtrend. You can see. So it's forming what? It's forming series of lower lows, lower high. You can see it. You can see. You can see. You can see. There is an indicator I use to quickly spot this trend. It's called zigzag. It's called zigzag. So if you add it to your charts, look at it. It will just give you that. See, let me remove my own black line. You can see it will just show you that trend straight up. You can customize it a little bit. Remove all of this and change this one. You can change this one to like 10 to make it. Remove all of this, calculate all these ones. Just take it out. Yeah, just take all of these things out. You can see. So it will just automatically tell you what the market look like. You can see it's already pointing down the arrow, so you know that this is a downtrend, right? So this is an example of a clean downtrend. Let's look for an uptrend. Let's go to USD JPY, Forex.com. You can see I've been able to even identify this guy here. Okay, so look at this. You can see this one, a very clean uptrend. If you add that zigzag, if you put the zigzag, you should be able to identify it. You can see how clean and easy this is. You can tell that, always zoom out. Like I said, always zoom out. You can see, this guy is in an uptrend. Look at, he's just trending up. You understand? So you always want to trade alongside the trend. Let's look for an example of a consolidating market. USD CHF. Let's go to FXCM. Okay, all right, look at this. Let me take this out. Yeah, all right. So look at this guy. Look at USD CHF. Yeah, we're having the market was dropping here, pushing back, dropped here again. Look at it. Then when it got to this place, it wasn't really moving. It was just moving sideways. Consolidating market are also called sideways market. Look at it. Yeah, so just moving sideways. No, there's nothing like it's not buying, it's just sideways. And I told you, once it breaks out to the downside, you can continue selling. Can you see? So it broke out here, sold off a little bit. So this is a typical example of a consolidating market. Market is just going sideways, not buying properly, not selling properly. There are many examples. So what you should do after this session, after this class, is open your trading view, get your book and your journal, try to identify some of these trends. You can message me directly. My Telegram stuff is already attached to this particular video. You can DM me directly if you need further assistance and all of that. Yeah, it's a community. We want to grow together and stuff like that. So it's all good. So look at it. Look at a clear consolidating market here. You can see it here. So that is how. So there are many more examples. By you look at this area also. See, you can see how the market is moving sideways here. It's not buying, it's not selling. So those are the kind of trends we have. Yeah, so moving on, top-down analysis. Daily, this is how I align my own trades. This is how I find my own sharp, clean setups. I start from the daily time frame. I identify the trend. I mark key levels. In subsequent classes, I will teach you about key levels, how to mark support, and how to use key levels to trade effectively, how to make money with key levels and all of that. But for now, with this knowledge I've been able to impact and you guys, don't worry. If you open your laptop and you'll be able to understand now, you know better than you did before. So that is basically how these things work. You have to always try to improve every single day. So daily, identify the trend, key levels, big picture. This is how I start my own analysis. On the daily, on the 4 hours, I confirm the trend. I find value areas and I identify setup. And 1 hour, I time my entries to look for this. So higher time frame sets the direction, lower time frame fine tunes the execution. Market structure is the foundation of smart trading. You have to understand market structure. If you cannot identify the market structure of that particular pair you want to trade, just stay away from it. You would easily lose money. Yeah. All right. So different key concept traders use. There are over 1 million strategies on. If you open YouTube now, you see this one will tell you his strategy is the best. This one will say, oh, I used $2 to make $10,000. Oh, I used $10 to make $255,000. All of those things, not them, no. Sure, you understand? Because I have a 4 years professional experience. I've been able to go round. There is nothing I haven't tried in trading before I finally sat down to coin my own strategy and put all of these things together. So different key concept. I'll just scan through some of these things. ICT, SMC, CRT, structure, liquidity, POI, break and retest. All of these things work. Do you understand? There are some traders that trade using ICT. They focus on. I also, when I started with ICT. Then at some point, I wasn't really profitable with it. I moved into SMC. Now I trade CRT, then all of these things. But with time, the more you see me do analysis and all of that, you would see that I'm quite different. Yeah, I brag a lot. Okay, so these are different strategies people use and all of that. So just for you to just know, there is no one way to enter the market. There is different ways to make money, different ways. Sure, you understand? You just need to know what works for you, what puts money in your pocket. That is what you should focus on, right? So focus on me. Let me teach you so you can get better instead of going around and all of that. So these concepts work together. You master the conference, all of that. So type of traders we have scalpers, we have day traders, swing traders, and position traders. So the kind of trader you would eventually become is depending on your personality. I started as a scalper. So what do scalpers do? Scalpers are traders that they are usually on the lower time frame, 1 minute time frame, 5 minutes time frame. The maximum time frame they are on is like 30 minutes. Remember that all those candles that you're seeing, if you're on the 1 minute, it means all those candles you're seeing takes 1 minute, 1 minute. If you're on the 5 minutes, 5 minutes. So there are some people that don't even really have patience. Like, they just want to quickly enter, make money and run away. They don't have time to be sitting and be waiting for 4 hours candle, 1 hour candle, daily candle. They don't have time. They just want to get in and get out. So those are scalpers. They work with those smaller time frames. Quickly, let me quickly look at what 1 minute and 5 minutes wants to do, so I can quickly make my decision and take a trade. So those are scalpers. They take small profits from small moves. They all trade for seconds to minutes. Day traders open and closes trades within the same day. So me, I am a day trader / swing trader. I do both. It's been a while now I scalped because So day trader and swing trade. So day traders are traders that come into the market. Remember, we talked about sessions. Come into the market, probably in London session, try to make money. By New York session, they are done. But these days, even day traders say you have to hold your position overnight sometimes, depending on the kind of setup you're on. So swing traders, they all trade for several days to weeks. So swing traders are traders that work with so day traders work with 1 hour time frame, M15, 4 hours and daily. Swing traders tend to work from 4 hours candle. You see, they are always very patient because you have to wait for you have to wait for numerous 4 hours candle for it to form, for it to close, and so you can start saying, okay, let me buy this. So you understand that kind of level of patience. So swing traders tend to, make more money. It's depending on your time and your schedule and the kind of trader you develop yourself to be. Right. So swing trader all trades for several days to weeks. They capture medium term moves. Position traders, these ones are they are the real big boys. I'm not talking about people with 50k dollars. No, more than that. Because this guy, they can just take one single position in 6 months and they will not trade again. They can take only 2 trades in an entire year. Yeah, they are that badass. So basically, position traders, they tend to wait and hold trades for months. In fact, 6 months, 7 months, 1 year. So they are the hedge fund guys, those guys with real liquidity. You know what liquidity means? Real money, good money. So those are position traders. So if I try to hold a position for months, hunger go wound me. So I can't. All right. So choose a style that fits your personality, time, and lifestyle. So it's depending on you. Do you have time to be a day trader? Do you have time to be a swing trader? Or you just want to scalp? Just want to work on those lower time frame. So with time, you develop yourself. Risk management. Risk only 1 to 2% of your account per trade. So professionally, you're supposed to risk just 1 to 2% of your account. Now, let me make a very small analogy here. Let's say you have a $10 account. Let me make it as small as possible. You have a $10 account. You want to trade it profitably. You want to trade it very well, right? So let me show you how risk management works. Now, your $10 account, you are supposed to just risk just $1 per trade. You don't risk more than $1 because using good risk management gives you room for error, just in case you're wrong. You can do analysis and all of that. You'll be wrong at the end of the day. You lose money. Yeah. But when you lose in trading, lose in a way that you still protect yourself. You protect your psychology. You protect your capital. You understand? So you have a $10 account. Your first trade is a $1 trade, right? You lost the trade. You took another trade. Second trade, you lost it. You took another one. Third trade, you lost it. That's 3 straight losses. Some other people will be panicking. Me, I don't panic. Right? You're not supposed to panic if you have good risk management. Now, my risk to reward I work with on the market is 1 to 3, which means I'm risking 1 to make 3, and I'm out of the market. Some people will try to use 1 to make 25. Some people will try to use 1 to make 1,000. Now them no. Everybody with what works for them. Me, I want to be consistently profitable. I want to just make money, be comfortable, be alright, and all of that without fear and greed. Because these are the things you're going to battle in the market in the long run. Fear, greed. You'll be greedy at some point when you see that, oh, this thing looks easy. I'm printing money from thin air. You become greedy, and the market would hurt you. You understand? So I work with 1 to 3, right? So let's assume. It means if I risk 1 and the trade goes my way, I'll be making 3 times my risk. So that is what 1 to 3 means. 1:3. That is what it means. So I've taken 3 trades. I've lost the entire 3. I took the 4th one. I won it. I risk another $1. I made $3. You see that I've been able to cover my 3 losses. You understand? Because I'm risking 1 to make 3. So I've made that 3 back. I've covered all my losses, my 3 losses. I used $1 to make $3 back. So I've covered those 3 losses and I'm back on break even. I'm back at my capital. If I take another trade and I win it, risking another $1 to make $3, it means I'm already in profits. So even if I lose, the essence of risk management, even if you lose 4 or 5 trades, risking consistently and risking very, very low, you are able to protect yourself and preserve your account. It's very important, right? So that is what risk management, that's how it works. So always use stop loss in your trades. Protect your capital first. Manage your risk, basically, and not the trade. So yeah, so that's what it is. So big gains come from small consistent profits. That's where trading is all about compounding. Some people would want to gamble it. They will they will deposit $1,000 and the first trade they are taking on the trade is on that particular account is like $300 or $500 straight. If you lose just 2-3 trades, you're out of the market. You start looking for capital again. That's not sensible risk management. You have to always apply risk management and always use stop loss. Stop loss means that, okay, I am wrong. I don't want to take massive loss more than what I already initially planned. Sure, you understand? So they close the trade for you. So it's very, very important as a beginner. So Forex trading checklist, these are some of my own checklists. As a trader, you have to have a trading plan. You have to be able to identify the trend and structure. Is your entry based on a setup or is it emotions? These are the things you struggle with: fear, greed. I don't want to, I've lost my previous trade. I don't want to, all of those things, right? So these are the things, what update is this? So these are the things you would face in the market. Is my stop loss placed in the right area? Is my risk 1 to 2% of my account? Is there clear take profits? Am I trading with discipline and patience? These are very important criteria. So in trading, you always have to follow your plan and not your feelings. Feelings can be deceiving, but your plan would structure you and protect you from devastating losses. So common beginners mistake: most beginners don't have trading plan. They risk too much. They trade with emotions, no stop loss, revenge trading, over trading, and they ignore market structure. So these are the things you need to work on. You need to develop with time. So avoiding mistakes is better than finding the perfect trade. Yeah. So my golden rules: protect your capital. You have to always respect the market at all times. The market is always right. It's the best teacher. Think in probabilities and outcome. Be patient. Good things take time. You learn, you adapt, and you improve every day. Discipline today simply means financial freedom tomorrow. I mean, you can have your normal things you do outside of these things and still be trading by the side to make little income for yourself. Sure, you understand? So that's how it works. So it's been amazing with you guys. Thank you guys so much for sticking around. If you stay to the end of this video, I love you so much. You're perfect. Thank you. And just please please subscribe, please share this video. Yeah, so it's been wonderful with you guys. Stay tuned as well, because I have so much knowledge to give you guys. I have so much things in my head I want to share with you guys. So much goodies. So yeah, so thank you so much for sticking around. Like, comment, share. Stay active, guys, and stay sharp. Thank you so much. Bye for now.